All right, let's dive right into this explainer. Today, I'm playing lead investigator, and we're doing something pretty unprecedented. We are cracking open the actual unedited tax returns of some of the wealthiest people in the country to uncover exactly how they protect their wealth. And listen, we're not talking about sketchy offshore accounts or illegal tax evasion here. We are talking about real storytelling through numbers, revealing the completely legitimate, IRS-approved strategies that are hiding right in plain sight.
To figure out exactly how the rich keep their money, I spent 3 grueling months agonizing over exactly 47 different tax returns. We were talking about private files from top-tier doctors, high-level tech executives, and savvy real estate investors spread across wildly different financial situations. And as I combed through line after line of these incredibly complex documents, I started seeing it, a pattern. Over and over again, regardless of the profession, the exact same 3 legal loopholes kept showing up.
Okay, let's do a quick reality check here. Think about the average hardworking American. They finally break into a top income bracket, and bam! They immediately lose an effective rate of around 26% of their income to taxes. But then look at the ultra-wealthy, people sitting on $10 million or more in assets. They are legally slashing their rates down to just 8 to 14%. That massive reality gap? It is absolutely not luck. It is pure strategy.
You know, former Senator Don Nichols once joked that the tax code is 10 times the size of the Bible with absolutely none of the good news. And honestly, he hit the nail on the head. It's an absolute monster to navigate. It's dense, it's frustrating, but buried inside all that complexity are real, legitimate advantages that wealthy teams actively hunt down. They treat the tax code not as a punishment, but as a rulebook for wealth preservation. And that brings us to the blueprint. Buried in that complexity are 3 specific, surprisingly low-risk loopholes that practically every single one of our highest earners used to legally beat the system. You've got the Backdoor Roth IRA for high earners, real estate cost segregation for property owners, and the Charitable Remainder Trust for folks with highly appreciated assets. The wealthy aren't gambling with the IRS. They are just utilizing the tools that are already built into the whole shebang.
So let's look at Loophole 1, the Backdoor Roth IRA, or as it's often called, the income limit workaround.
Here is the frustration. If you make good money, we're talking over $146,000 as a single filer or $230,000 if you're married in 2026, the IRS essentially locks the front door to a Roth IRA. They say you make too much money. But get this, out of the 47 returns I reviewed, an unbelievable 38 of them creatively bypass those strict limits just by walking right through the back door. 38! They simply put their money into a traditional, non-deductible IRA, which has 0 income limits, and then almost immediately cleanly convert it into a Roth IRA. Since the money just got deposited, there are basically no gains to tax during the conversion. It is 100% legal, and Congress is totally aware it's happening.
Now, why bother with the extra paperwork? Because the payoff is literally massive. If you max out a $7,000 contribution starting at age 40 and consistently use this backdoor strategy, assuming average market returns, you could quietly pile up over $400,000 in completely tax-free retirement money by the time you hit 65. And when you go to pull that cash out in retirement, you pay absolutely 0 taxes on it. But listen closely, because there is one little plot twist you got to watch out for. It's called the pro-radar rule. Basically, it's a tricky little math complication that gets triggered during a Roth conversion if you happen to already hold other pre-tax IRA money lying around in a different account. If you do, the IRS will make you pay taxes proportional to your pre-tax and after-tax balances. Seriously though, don't let this stop you. A quick hour with a competent CPA will sort that math right out. All right, moving on to Loophole 2. Real estate cost segregation, which is essentially the depreciation accelerator.
This strategy honestly shocked me the most out of everything in this investigation, but literally 100% of the real estate investors in our study used it. Every single one. The contrast here is staggering. Normally, the IRS makes you write off a $500,000 property over a painfully slow 27.5 years. That gives you roughly an $18,000 deduction a year. Yawn, right? But jump over to the accelerated cost segregation version. Instead of 18 grand, you might instantly claim an $80,000 or even a $100,000 deduction in a single year. That wipes out a huge chunk of your taxable income right when you actually need it.
So how exactly do they pull this off? Well, investors pay a qualified engineer to come in and literally break the property down into individual components. We're talking carpeting, lighting fixtures, landscaping, appliances. Since these items don't take 27.5 years to wear out, they get reclassified for way faster depreciation. Combine that with the bonus depreciation rules for 2026, and investors can legally deduct 60% of those newly qualified property costs right away. You pay a few grand for the study, but it routinely translates to tens of thousands of dollars in instant tax savings. It's a real game changer.
And that brings us perfectly to Loophole 3, Charitable Remainder Trusts, or the give it away and keep the income strategy. This is the climax of our investigation, specifically designed for folks holding highly appreciated assets of $250,000 or more. Say you have a business you want to sell, or a massive stock portfolio you've held for decades. Sell it normally and you get absolutely crushed by capital gains taxes. It sounds like an impossible magic trick to avoid that, but here is how it works. Let's say you bought stock for $50,000 and now it's worth $500,000. Step 1. You transfer that stock into the trust. Step 2. The trust sells the stock tax-free, entirely avoiding a massive $90,000 tax bill. Step 3. The trust invests that full $500,000 and pays you a lifetime income stream, usually around 5 to 8% a year. Oh, and you get an immediate charitable deduction today. Finally, Step 4. When you pass away, whatever is left goes to a charity of your choice. A win for you, a win for charity, and 0 massive checks written to the IRS.
So, naturally, you might be wondering, if these IRS-approved strategies are so incredibly powerful, and if the absolute wealthiest people use them every single year, why hasn't your own CPA mentioned them to you during tax season? It can be pretty frustrating, right? But the answer actually isn't that your accountant is purposely hiding things from you.
It really all comes down to a crucial mindset shift that we noticed across every single one of those 47 returns. See, most everyday accountants operate in backwards-looking, reactive compliance. Their whole job is just to record what happened last year and file the paperwork accurately in April. But millionaires, they demand forward-looking, proactive planning. They are sitting down with their tax teams in October or November, mapping out moves to make well before December 31st. They aren't just filing taxes, they're actively shaping their tax liabilities before the year even wraps up.
Which brings us to your next 3 steps. Here is your action plan for the next 7 days.
Like we always say, knowledge without execution is just trivia. You've got the playbook now that the wealthiest 1% use to protect their money. But watching an explainer doesn't save you a dime unless you actually take action. So here's your specific plan. Step 1. Check your income against those Roth IRA limits, and if you are over the line, call your brokerage this week and ask them directly about their backdoor Roth process. Step 2. If you own any rental property at all, type Cost Segregation Study plus your city into Google and just get 1 free quote to see the potential math. And Step 3, walk into your next CPA meeting and ask them specifically about these 3 strategies. A great accountant will literally light up at the chance to do real planning. A mediocre one, they'll fumble, and if they fumble, well, you know it's time to upgrade your team.
So, we've solved the mystery. The wealthy do not have some separate secret tax code, they just use more of the one we all share. The IRS built every single one of these legal strategies into the system for anyone to use. They are fully documented, completely legal, and undeniably powerful. So now that you've seen inside these 47 returns and you know the secrets, what will your next move be?